Financing with debt. What are the advantages and disadvantages of a business using debt financing to borrow or not to borrow? That is the question. Benefits of using leverage debt financing. Accelerated return on investments. One of the primary blessings of the use of leverage debt financing is the capacity to increase returns on investments. By borrowing money to invest, individuals or companies can increase their buying power and probably generate better profits than in the event that they had only used their own capital. Tax advantages. Interest payments on debt are normally tax-deductible. This results in lower tax liabilities for companies making use of leverage. This benefit is an advantage of debt financing in comparison to other types of financing. Flexibility. Debt financing offers flexibility in managing cash flows and working capital and allows businesses to access additional funds without diluting ownership or control. Asset utilization. Leverage financing enables businesses to make use of assets that might otherwise remain idle or underutilized. Improved growth opportunities. Leveraging debt can boost a business's growth by providing immediate funds to take advantage of additional business opportunities. Dangers of using leverage debt financing. Increased financial risk. One of the maximum vast drawbacks of leverage debt financing is the heightened monetary risk it introduces. Borrowing cash exposes businesses to interest expense fluctuations, repayment responsibilities, and the capability for insolvency if cash flows are inadequate to cover debt obligations. Interest fees. Even though interest payments on debt may be tax-deductible, they nonetheless represent an economic burden that need to be factored into the value of capital. High interest rates or unfavorable mortgage terms can erode profitability and stress cash balances, in particular during business downturns or durations of low revenue. Lack of management control. Taking on additional amounts of debt can result in a loss of independence where lenders can impose restrictive covenants or conditions that limit managerial decision-making freedom, potentially affecting strategic decisions and operational flexibility. Credit risk. Relying heavily on leverage increases credit risk exposure, especially if monetary conditions go to pot or marketplace dynamics shift unfavorably. An excessive degree of indebtedness can negatively impact credit scores, making it extra tough to obtain future financing at favorable terms. Leverage amplification. While leverage has the potential to increase returns on successful investments, it also amplifies losses in case of underperformance or economic distress. The same leverage that enhances profitability for the duration of prosperous times can increase financial difficulties for the duration of downturns. Quick question: your business has an investment opportunity that earns 10% and you've been offered financing at 25%. Should you jump on this deal? I hope you said no. Common sense should tell you that this is a losing proposition.